At its root, the cannabis industry is a commodity business, and like all commodities, producers and retailers find themselves at the mercy of trends in wholesale pricing that they have little to no direct control over. For example, as a cultivator, you may build your entire operation around a cost per gram that ensures a profit at the end of your production cycle. But if the cost per gram suddenly drops due to market saturation or a downturn in demand, you may find yourself in the red despite executing your business plan perfectly. Price uncertainty regarding both today's prices and those in the future creates risk for individual businesses, as well as in the overall economics of the sector. GreenGrowth CPAs has partnered with CannabisBenchmarks, a leading provider of financial, business, and industry insights, to develop this guide, demonstrating the fundamentals and value of price risk management. In this video, the first of a three-part series, we will examine the potential and basics of cannabis price risk management, including what is hedging, understanding market price risk, volatility as a measure of uncertainty, benefits of forward markets, and cash markets versus forward markets. So before we dive in, be sure to like this video and give us a follow for more cannabis news and updates. As always, the information contained in this presentation is meant for guidance purposes only, and not as professional legal or tax advice. Further, it does not give personalized legal, tax, investment, or any business advice in general. Hedging against price risk simply means strategically deploying financial, purchasing, and/or market strategies to mitigate the risk of negative price movement. You're essentially taking out insurance against price volatility to lessen the impact of adverse trends. As a relatively young industry, price risk management is a comparatively new concept in the cannabis and hemp sector. Transactional volumes remain highest in larger geographies with multiple buyers and sellers, relatively stable regulations, and little vertical integration. But even with higher volumes traded, prices continue to move in unpredictable ways, creating wholesale price uncertainty for buyers, sellers, and supporting ancillary businesses. Additionally, the establishment of new state legal cannabis systems has accelerated recently, creating new markets where supply, demand, and price dynamics are uncertain and will continue to evolve for some time. Looking further, but hopefully not too far ahead, federal legalization of the cannabis industry and allowances for interstate commerce will introduce a whole new layer of uncertainty in cannabis prices. Managing exposure to market price uncertainty is a critical requirement for growing businesses, and that need is most apparent in several key activities. Cost and margin management. Buyers facing uncertain wholesale markets seek stability in their cost base, margins, and cash flows. Revenue management. Sellers also contend with uncertain revenues that impact margins and cash flows. Growth planning. Decisions regarding where to expand and what type of facilities to build are directly affected by expected future prices and are undermined by uncertainty. And finally, third-party funding. Capital providers rely heavily on forecasted revenues that are extremely sensitive to wholesale market fluctuations. One very common way to measure the level of price uncertainty for any commodity is volatility. This metric provides a measurement of how much prices would be expected to change over an entire year on average and can be expressed as percentage change in prices. Measures of volatility do not indicate direction of price change, but provide an indication of the magnitude of price swings. This graph compares the actual measured price volatility of selected cannabis markets with other products during 2020. The green bars are the CannabisBenchmarks spot indices for the US and the major Western markets. The blue bars are commonly traded non-cannabis commodities. In analyzing this chart, several key observations emerge. For 2020, cannabis price volatility in the most mature markets was similar to other established agricultural commodity sectors, while energy markets, natural gas, and crude oil were the most volatile of all major global commodity markets. Volatility is typically greater in new and emerging markets like cannabis, compared to more established markets, since the latter tend to have a greater number of participants, higher trading volumes, and better defined rules and venues for trading. Market price volatility can be troublesome for all the participants in the value chain. Traditional supply and demand elements such as weather and market conditions drive many agricultural markets. However, significant price movement in cannabis markets appears to still be driven largely by regulatory decisions, a trend unlikely to change in the short term. New commodity markets typically begin as physical transaction-only markets, which tend to be fragmented across regions and quality levels. Eventually, buyers or sellers begin to look for transaction agreements that cover a series of deliveries over some forward period, ranging from months to years. Forward deals or contracts are agreements between buyers and sellers to deliver a certain amount of a specific type of product at specific points in the future. One example would be a series of bi-weekly deliveries over the next 6 months, all at the same fixed agreed upon price. Such arrangements can be advantageous to both buyers and sellers. Buyers gain consistency in their expenditures, as well as a predictable supply of product of known characteristics, rather than scouring the market ad hoc to replenish depleted inventory. Sellers benefit by securing regular revenue, in addition to the knowledge that the product will be moved and will not require storage and upkeep for an indeterminate amount of time while it is shopped around. Expectations regarding prices for future deliveries are typically shown in what is called a forward curve to facilitate longer-term transactions. CannabisBenchmarks produces an implied forward curve that reflects 6 months of forward benchmark price assessments. This curve summarizes the price buyers are agreeing to or willing to pay cultivators for delivery at a date in the future. Payments are made at delivery. So this graph shows the monthly average for the US spot index from July 2020 through July 2021, appended with the 6-month implied forward curve, reflecting the market's expectations for wholesale prices through January 2022. Many market participants armed with an understanding of forward prices and seasonal pricing trends can employ forward deals to their advantage, using a variety of contract structures to manage their exposure to different spot and forward prices. It is important to make the clear distinction between cash markets and forward markets to understand how price risk management tools are used. The cash market refers to the current physical goods market. These transactions take place at specific locations and are immediately settled, so that the cash and the commodity are exchanged concurrently. The majority of current cannabis transactions occur in the cash market. The forward markets include all transactions and pricing that are agreed to now for delivery and payment in the future. These take the form of a legal agreement between two parties to buy or sell an asset at a specified future time at a price agreed upon today. The details of these private, unregulated agreements can be customized between the parties. Market price uncertainty can only be managed in the forward market, since the very nature of the cash market involves a spot commodity price. The forward market agreements require the parties to transact at a specified price. Typically, there are two general types of forward price specifications: fixed and indexed. Fixed prices specify a particular absolute price, such as $1,400 a pound, whereas index prices specify a particular index or benchmark that would be known or settled only in the future. An example of an index price specification might be, price paid is equal to the CannabisBenchmarks Oregon Spot Index for the week of delivery plus $25 a pound. Note that the fixed pricing eliminates price uncertainty, while the index pricing retains some price uncertainty. By using a combination of fixed and index pricing agreements, cannabis market participants can manage market price risk in a way that best suits their particular needs. As business advisors to cannabis operators throughout the supply chain, we help our clients design and implement a variety of risk management strategies and procedures. If you'd like help assessing how a price risk management strategy can help your cannabis operation, please reach out to us at GreenGrowthCPAs.com or by calling us at 1-800-674-9050. And don't forget to check out our partners at CannabisBenchmarks. As an independent, unbiased wholesale price reporting agency and the creator of the world's first spot and forward benchmark price assessments for US and Canada's legal markets, they are a great resource for all kinds of useful cannabis business and market information. Check them out at CannabisBenchmarks.com. Thank you so much for your time. We hope this information has been helpful. If you have any questions or want more information, please leave us a comment below. And be sure to like this video and give us a follow to learn more about the cannabis industry.